Good morning, everyone, and welcome to day 2 of the Singapore Trading Festival 2022, brought to you by SGX and Equities Tracker. So if you missed out anything on the opening day, not to worry, we will have recordings available for you on this website. So before we start, just a quick note, we want to flash the slide to let you know that the views and opinions expressed by our speakers are in their personal and professional capacities. So also, we want to encourage you, if you're here after watching this session, do take a look at the exhibition area. So here you are in conference room 1, but if you head out to the main lobby, and click on the bottom left side, there are these arrows pointing you to the exhibition area. We have a great selection of brokers there. They're running promotions, and in each of the brokers areas, you can actually click on the picture of the lady on the right if you'd like to chat live with their staff. Yes, it's like in the actual physical events where you can speak with the exhibitors, so you can chat live with the staff. So do check out the exhibition areas. But now, folks, we want to talk about something really important. One of the biggest things to happen this year with regards to central bank actions is undeniably US Federal Reserve Chairman Jerome Powell announcing that there will be at least a 25 basis points rate hike at every Fed meeting for the rest of the year. So folks, we've become very used to rock bottom interest rates. So what happens next for our REITs sector, which is very sensitive to interest rates? Providing some answers for us will be Mr. Chua Su Tye. He's the head of REITs research and Maybank Investment Banking Group. So, Su Tye, over to you.
Okay, good morning, everyone. Thank you for taking time to join us today. My name is Su Tye. I'm head of REITs research at Maybank Securities in Singapore. The title of my presentation is Singapore REITs Hiking on Growth. So I will take you through this in the next 25 to 30 minutes. And after that, we will have time for Q&A. So let me just share my slides with you now. So I think it may be a bit more punchy if we consider our thesis under the headlines of what I would call the 5 R's. So that would be rates, recovery, rents, recommendation, and risks. So on the first R, rates. So rising interest rates are a major headwind, especially for the REIT sector. The US yield curve had steepened in 2021 in anticipation of rate hikes. So the 2-year bond, I think, is now yielding 2.15%. It's close to our year-end target for Maybank. And it's versus the 10-year Fed funds rate of, I think it's right now, 2.36%. We think that further steepening of the yield curve is unlikely for now. The impact to sector earnings and valuations is also manageable in our view. So on recovery, so when we observed the fourth quarter FY21 earnings report card for the S-REITs, I think what we saw in summary was evidence of broad-based DPU recovery across the sectors on the back of resilient occupancies, and importantly, I think improving leasing sentiment and momentum going into the year. We expect a stronger earnings outlook against the positive macro overlay and further reopening efforts. So I think, let me show you this. So I think DPUs grew about 10% last year. We expect this to accelerate to 12% in FY22. This will be due to the absence of rental waivers, rising rents as business activities normalize, and contributions from acquisitions. And then on the third R, rents, we like office. Office sector is recovering on stronger than expected demand, and with supply constraint, pricing power has come back to the office landlords. So we are forecasting rents to rise 12% through 2023. I think a more active physical market will increase inorganic growth opportunities for REITs, especially
as... I just want to jump in really quickly. Unfortunately, we can't see your slides at the moment. If you could just check whether you're sharing the slides.
Oh, okay. Let me just see.
Just want to double check that with you.
Yeah, I'm on slide 2 right now.
Could you share the slides and see whether that's working?
Sorry. Let me just quickly move that.
Perfect. Thank you very much.
So sorry for that.
Yeah, we can see that clearly now. All right, back to you, Su Tye.
Yeah. Okay. So I'm still on slide 2, and I wanted to go on slide 2. Essentially is a summary of our investment thesis, and I really wanted to go on to the point that I was making on recommendation, which is going to be our fourth R. So I think right now the sector is still under-owned. We like the office REITs. We like the large cap industrial names with new economy exposure. Our top picks are Ascendus REIT, that's A REIT, CapitaLand Integrated Commercial Trust, that's CICT, Maple Tree Industrial Trust, MINT, and Suntec REIT, that's SUN for short. They're expected to deliver higher total return potential, that's 5.5% to 6% dividend yield, and also 4.5% to 7% DPU growth. And then finally, I must add this in, the fifth R, which is on risks. After interest rates, we also need to consider the overall global macro backdrop. Now, Singapore's non-oil domestic exports growth, that's NODX, in February eased off to a 6-month low of 9.5%. In January, it was about 18% growth. We see headwinds from the Russia-Ukraine war and China's flash lockdowns. Just a week ago, we cut our GDP growth forecast to 2.8%. For this year, that's previously at 3.8%. That's on the back of lower global and EU growth, higher energy prices, and manufacturing supply chain disruptions, and a more aggressive Fed tightening policy. On a more optimistic note, however, I think Singapore is now trying to execute what is already being seen in certain developed markets. That's treating COVID-19 as a pandemic. More loosening measures were announced 3 days ago. I think the relevant ones for us being first, expansion of dining group sizes, and second, freer unencumbered travel. So that's allowing all vaccinated travelers to enter Singapore without quarantine from 1st of April. So right now, I'm just going to go over to the next slide here. I wanted to talk about interest rates. So interest rates expectations are key risk for the sector. Recent US Fed comments suggest rate rises continue its trajectory, but remains a dynamic approach. So our fixed income team sees 10-year bond yields reaching 1.9% by the end of this year. It will peak somewhere at 2 to 2.25% in this cycle, whether the Fed hikes rates at a measured pace or they hike rates at a faster rate in the next 12 to 18 months. On the right-hand side, you'll see that Singapore REITs have pulled back by about, I think they corrected sharply by 20% in 2015 rate hike cycle. They pulled back by much lesser 11% when the Fed hiked rates 3 times in 2017 to 2018. That's against more benign shifts in the yield curve. They corrected by up to 9% from the recent November 2021 peak. They have retraced this back up to 7% since then. We think that volatility will stay. It's also an understatement to say that there is significant market uncertainty. On to this slide, I think I wanted to show that fluctuations in interest rate expectations will remain a key risk, but balance sheets across the sector are strong. So the REITs have pushed up their fixed rate borrowings to an average of 72%. That's on the second column from the left. We did a sensitivity analysis and highlight that every 50 basis points change in our interest cost assumptions would result in a 1 to 4% lower in terms of the DPU forecast in our models. Also, every 50 basis points increase in our discount rates in our valuations would result in an average of 9% cut in our DDM values for our Singapore REITs. The sector yield spread to the 10-year Singapore government bond stands at 3.6% now. That's close to 1 standard deviation above the 5-year historical average. We think that higher rates are largely priced in. If we look at where the large cap REITs are trading at, that's on the right-hand side, then we can see that their valuations are undemanding. Just push this out. Yeah, we can see that the valuations are undemanding. Oh, I'm so sorry. Just give me a moment here. Yeah. Yeah. Okay. Yeah. Let me go through this. So I think I want to mention that on a total return basis, the REITs are trading at 6 to 9% dividend yield. We expect them to generate 2 to 3% DPU growth for retail. That's up to 7% DPU growth for office, between 2 to 6% growth for industrial, and a higher 8 to 25% for hospitality. As we all know, RevPARs here are recovering from a low base. So these are some of our valuation tables. We cover, as you know, 19 out of 44 of the Singapore REITs and property trusts that are listed in Singapore. We have a couple of buys here. Of course, I'll be ready to take questions later on some of these, but I wanted to show you our valuation tables. So I want to jump right now into the subsectors, starting from office. So leasing activity that's driven by new and relocation demand in Singapore picked up on improving sentiment in the second half of last year. That's driven by new demand from tech. You can see that in the pie chart on the left-hand side, and expansion by asset and wealth management sector occupiers. They generated 52% of demand last year in terms of leasing volume. They've essentially overshadowed space rationalization by firms adopting hybrid work arrangements, resulting overall in positive net absorption in Singapore. I think in the CBD, many tech firms have their footprints in Grade A buildings, with large floor plates of around 30,000 square feet. Just to share some of these with you, Red Hat, which is a subsidiary of IBM, occupies 60,000 square feet at Capita Spring. Capita Spring is a new property in Singapore that received its TOP at the end of last year. LinkedIn expanded at MBFC Tower 2. Twitter has leased a floor at Capita Green. TikTok has about 100,000 square feet at One Raffles Quay South Tower. ByteDance occupies 60,000 square feet over 2 floors at Guoco Tower. Gojek recently relocated from AXA Tower to occupy 24,000 square feet at Suntec Tower 5. We look on the right-hand side, committed occupancies, they climbed in the fourth quarter of last year. Asia Square Tower 2 occupancy is right now at 95.6%. Previously, it was about 83%. That's due to rapid backfilling of vacancies. Capita Spring has gone up to 91.5%. Suntec's office occupancies in Singapore, they've moved up also, up at Suntec Tower, One Raffles Quay, and then MBFC Towers 1 and 2. I think this chart shows a Grade A office rents on the left-hand axis, and then island-wide vacancy, which is inverted on the right-hand side. You can see there's a very strong correlation between the two. Fourth quarter vacancy rate was 6.3%. That's versus 6.8% in the third quarter of last year. Now, this was 4.5% in the fourth quarter of 2019. This was 3.8% in the fourth quarter of 2014. So I think there's room for this vacancy to tighten further by about, I think, 1.5% to 2%. This will drive the increase in rental expectations. I think total new supply for office is estimated at 3.7 million square feet over the next 3 years. That's equivalent to 1.2 million square feet per annum. That's 13% lower than a 10-year historical average of 1.4 million square feet in gross completions. 35% of the new supply pipeline is located within the CBD. The remaining 36% is in the fringe, 30% in the decentralized submarket in Singapore. Supply in Singapore is further tightened by the redevelopment of some of the older office buildings, and also we have labor scarcity delaying some of the upcoming completion timelines. So we have in Singapore, Capital Towers, that's 500,000 square feet, estimated to complete in 2024. We have Shaw Tower, about 400,000 square feet. Fuji Xerox Tower, 300,000 square feet, and AXA Tower, close to 1 million square feet, only adding to supply from 2025 onwards. And therefore, you don't see this on my chart on the left-hand side. So onto the right-hand side, then rents fell 10% year-on-year in 2020, but they recovered by 4% year-on-year. The office rental down cycle was very short-lived. Grade A core CBD rents, they grew 3.8% year-on-year last year to $10.80 per square foot per month in 2021. That's after declining 10% year-on-year in 2020. Now, this is less than 15% decline in the 2011 to 2013. That's also less than the 21% decline that we saw in 2015 to 2017. So as a house, we are forecasting grade A rents to accelerate as they rise 7% to $11.50 by the end of this year, or over 12% over the next 2 years. I think I'm going right now to industrial REITs. So industrial REITs saw stronger contributions from their overseas properties, and then AUM growth underpinned by further concentration into new economy segments. Warehouses, data centers, and business park space were 71% of the REIT's total AUM in 2016. They are now 81% of total AUM. On the right-hand side, you can see, Ascendas REIT, which is the largest industrial REIT, they added 2.1 billion of acquisitions last year. It remains the largest owner of new economy AUM amongst the peers. In Singapore, IT segment, data centers, biomed, and engineering sector occupiers accounted for over 60% of new demand by gross rental income last year for them. So new economy sector tenancies, that's now at close to 80% of gross revenue. They're all growing. And they push vacancies to the tightest in 5 years, and they should support leasing efforts into the coming quarters. Occupancies have been improving. Rental recovery is underway. So rental reversions for one of the Singapore REITs here on an aggregate basis, Mapletree Industrial Trust, they turned positive for the first time in 5 years. Expansion demand coming in from also third-party logistics players, e-commerce players, food storage occupiers have contributed to stronger leasing activity, and they've kept warehouse occupancy stable at 90% in the fourth quarter of last year amid higher new supply. As of the fourth quarter of last year, ground floor warehouse rents are $1.66. That's up 7% since first quarter of 2020. Prime logistics rents are $1.47. That's up 12% during the same period. Factory rents were up 1% quarter on quarter. I think the industrial sector should see a pickup in supply similar to 2013 to 2017 levels, but these are largely concentrated in multi-user, single-user factory space. Warehouse, particularly, supply remains manageable. That's 4.2 million square feet this year, as it moderates from 2023, that was 2.4 million, when compared to an average of 4.6 million square feet per annum in the past decade, or 4.1 million square feet per annum in the last 5 years. So rents increased 1.8% quarter on quarter in the fourth quarter of last year, and that makes up 5.6% year on year for the full year 2021. We are seeing demand for storage trickling down to second-tier warehouses from limited availability in prime logistics space. We expect this to strengthen with easing supply. However, we think the pace of recovery to moderate at about 2.5% year on year in 2022 to remain ahead of 2.2% year on year in factory rents. The stronger recovery in office rents will suggest a similar trajectory for business park rents. I want to move on to retail. Retail sales increased by 11% after 3 years of decline. The performance has been mixed across trade segments. Full year growth was supported by improvements in discretionary segments such as motor vehicles, clothes and shoes, watches, jewelry, recreational goods. Excluding motor vehicles, retail sales were up 11% year on year last year. The rebound was helped by year-end shopping. Retail sales expanded by about 7% in the month of December. It picked up from 2% year on year in the month of November. Online sales surged during the pandemic. They've closed to about 14% at the end of last year. I think we expect online sales to grow at double digit going forward. I took this slide from CICT. They reported tenant sales in the month of December 2021 that was stronger at 85 to 105% of 2019 levels. This compares also to the 77 to 96% for the full year of 2021. I think also if you look at tenant sales, this continued to track ahead of shopper traffic. So shopper traffic has recovered, but still a little bit slower, 56 to 65%. I think retailer sentiment has already started to improve. The government is now pushing towards endemic living. I think we see room for recovery to strengthen with further easing of capacities in 2022. Increase in dining capacities will benefit F&B. F&B is a segment that now makes up more than 30% of trade mix across the REIT portfolios. Outdoor mask-free and then lifting of alcohol consumption is going to be another booster. Okay. I still want to stay here. I want to mention a mall, VivoCity. VivoCity's recovery was slower in the December quarter. Tenant sales have reached nearly 90% of pre-COVID levels. That's due to limitations on large-scale sales events. But similarly, the firmer reopening trajectory that has just been announced just over a week ago, that mall atriums can now be open. That will mean that metrics will be better in FY23. I think retail, if we look at supply, then retail supply also remains constrained. We have about 1.2 million square feet over the next 3 years. That's equivalent to about 400,000 square feet of new supply per annum over the next 3 years. And it's versus about 0.8 million square feet in the last 5 years. It's also compares favorably to about 700,000 square feet in the last 10 years. And I think right now I want to move on to the final segment we have is on hospitality. I think for hospitalities in Singapore, gross lettings in 2021 remains depressed. That's about 30 to 40% of pre-pandemic levels. as border closures capped visitor arrivals to around 300,000 in 2021. That's versus a peak of 19.1 million in 2019. Singapore has in recent months progressively reopened its borders with the establishment of new vaccinated travel lanes, facilitating higher visitor arrivals, while room occupancies primarily supported by demand from government isolation contracts. Here, RevPAR recovery picked up pace in the fourth quarter of last year, that you can see on the right-hand side, with the opening of the VTLs from November. I think looking ahead, the pace of tourism recovery will depend largely on the arrangements with China, India, Indonesia, Malaysia, and Australia. Together, these 5 markets accounted for 55% of total tourist arrivals in 2019. The progressive reopening of borders provides a positive outlook for the sector. They could benefit from pent-up travel demand when cross-border travel eventually returns. Tourist arrivals worldwide could increase by about 30 to 70% this year. They will expect to return to pandemic levels at the earliest in 2024. That's according to the World Tourism Organization. I think the respective domestic markets should lead the recovery ahead of the progressive return of large-scale events. These are still subject to easing of restrictions. Outlook across markets still pretty much uneven. And then, of course, right now, with the heightened security concerns brought about by the ongoing Russia-Ukraine conflict. We expect RevPARs to recover off a low base, but visibility is low, especially for the first half of this year, as demand from government business tapers off and the competition for leisure and corporate travel intensifies. Room supply projected to grow 2.2% through 2024. Supply is expected to increase by about 4,600 over rooms, average of 3.3% per annum through to 2023. A majority of these, 80%, are concentrated in the luxury upscale segment. I think I want to mention here also for the hospitality REITs, Ascott Residence Trust, that's ART, City Developments Hospitality Trust, that's CDLHT. They pivoted to more stable income assets of purpose-built student accommodation, or PBSA, also rental housing, and also to build to rent properties amid a very slow RevPAR recovery we've seen here. I think I want to mention also specifically that ART has achieved a strong growth momentum and raised its target allocation in longer stay accommodation to 25 to 30% of its AUM. That's from previously 15 to 20%. It remains our pick within the hospitality REIT space. I think it's be useful if we overlay our earlier discussion on the different subsector fundamentals with the outlook on supply, which is on the slide, and then also for demand. Here, sorry, I don't have, I'm so sorry, I didn't put this into the slide here, but let me quickly jump onto here, I think. Yeah, so I think here we have details on the supply outlook, occupancies and rent growth projections over the next 2 years. We covered the majority of this content in the earlier slides. If I may, perhaps I can draw your attention to our forecast on rental growth, which also helps sum up on my earlier discussions. Here we can see Orchard Road rents have declined by almost 12% since 2019 to a 13% premium to suburban mall rents, from previously a 30% premium. So we forecast Orchard Road rents to rise 3.8% year on year in 2023, ahead of suburban mall rents. On offices, we discussed office in much detail just now, and because supply of grade A stock will tighten this year, then we expect rents could rise about 6.5%. We forecast 6% rise in office rents next year. We think that risk is on the upside given the strength of demand and also constraints in supply. You can see for the industrial properties, warehouse rents, they climbed the fastest last year. That's up 5.1% year-on-year versus factory rents that was up 2.7% year-on-year. And then business parks rents, which grew about 3.3%. We expect improvements this year. Warehouse rents, I think, will likely moderate to increase, in our view, 2.4% year-on-year. It will still be ahead of the 1.7 to 1.9% growth for factories and business park space. And finally, on hotels, RevPARs will likely jump 13% year-on-year this year, and a stronger 17% year-on-year next year. I think this is due to the stronger corporate calendar and also potentially a more meaningful return of leisure travel. I think risks are on the upside as well. And then finally, we have some of the indicators and forecasts here from our macro team. I thought it'd be useful to share. I'm not an economist, so I thought it's worthwhile to give a quick comment on inflation. I think inflation eased to 2.2% in February on the back of softer food and service costs, while headline CPI 4.3% was driven by surging COE prices and higher rental costs. I think we are expecting CPI to rise and then core CPI to grow this year. And then finally, I think these are some of the REITs here that we have in terms of our coverage. I wanted to just focus on the three top picks that we have, which is on Ascendas REIT here, and then second, CICT, third, Mint, and then fourth, Suntec. I think for Ascendas REIT, first, for its globally resilient portfolio and also resilient operating metrics backed by new economy property segments, these are now 80% of the AUM. We expect rents to rise and reversions to be at low single digit. That's similar to last year. Recovery is underway. We think there could be upside to management's guidance. The acquisitions have added to DPU growth visibility. We expect them to do more, given they have about nearly 5 billion in debt headroom to potentially deploy. I think we also like, all the way at the bottom, CICT. You have tailwinds from office sector recovery that will boost its NPI, and also better fundamentals on the retail side that will mean easing negative rental reversions. We are forecasting DPUs to jump 12% year-on-year in the absence of rental waivers. We have also completion of various Singapore office AEIs and contributions from 3 new Australian properties, and at 7% 2-year DPU growth. It has a strong balance sheet, and we expect deal momentum to pick up in Singapore. After the divestment of JCube, I think in fact, just on Friday night, CICT announced the acquisition of 79 Robinsons Road together with CapitaLand open-end real estate fund, that's COREF, for 1.3 billion Singapore dollars. That's at 4% NPI yield, with the transaction expected to achieve 2.9% DPU accretion. On to this slide, where all the way at the bottom, Mapletree Industrial Trust is amongst our top picks. Data centers is a preferred industrial asset class. This is now 53% of their assets under management, 37% of their revenue base. They have a strong balance sheet, and they're targeting to grow this segment up to 2/3 of the portfolio from acquisitions. We said earlier that industrial rents are bottoming out and growth should accelerate next year. Finally, we like the next slide, Suntec REIT. We forecast DPUs to increase at 6%. That's coming from rising contributions from their UK acquisitions. They have 2 assets there, the Nova Properties and the Minister Building, both in London. You have also better performance at Suntec City Mall with the reopening, and then 12% growth assumption for Singapore office rents that we are forecasting. The physical office market is active based on the volume of transactions, which has been strong and growing, and the outlook is improving. This will increase acquisition growth opportunities, especially if as the cost of capital improves. Okay, I think I'm going to just stop here right now to take questions from the chat group here. Thank you so much.
There are a good number of questions, Su Tye. Top voted one is, what's your view? You've mentioned this already, but perhaps go into a bit more detail on this, because they're asking about retail REITs, and the one name they mentioned was Lend-Lease.
And yes, so Lend-Lease, we don't cover Lend-Lease at the moment, although I think, therefore we can't have a sort of a formal view in terms of recommendation on the stock. But Lend-Lease is a REIT in which the portfolio of assets as a retail REIT is simple, because they just have three. They have 313 assets, 313 Orchard, right, in Orchard Road. They also have an asset in Milan that is leased for another 15 years. And then also very recently, they've acquired Gem Mall, which is a suburban mall, and that's trading extremely well. And so you have a REIT that is as a retail or commercial REIT. In fact, it's actually a commercial REIT, not a retail REIT per se, but it is a REIT that is simple to understand because you can focus on three assets. And these three assets are performing well. So we will expect, as a retail sector, we like suburban malls ahead of downtown malls. The reason for that is because so far, if we look at tenant sales for suburban malls, they have performed better than tenant sales for downtown malls. And the reason for that is because there has been this trend of work from home. So therefore, there is demand supporting overall tenant sales at the suburban malls. We will expect some of this to reverse when some of the workforce goes back physically to the workplace. But nonetheless, tenant sales are improving on the back, also on improving consumer sentiment. Therefore, I think overall suburban malls should still continue to perform better relative to downtown malls, which are still to some extent reliant on tourism coming back to Singapore. We will expect tourist numbers to reach back to pre-COVID levels only in 2024 at the earliest. And therefore, overall, I think the recovery for downtown malls is still going to lag suburban malls. But that's it, because as I mentioned earlier also in my slides, that because of where downtown mall rents are trending, the gap between downtown mall rents to suburban mall rents is just 13%. At the peak, it was 30%. And therefore, because of where downtown mall rents have compressed, we expect there to be earlier recovery in downtown mall rents next year. We are forecasting about 3.8%. Suburban malls, we are forecasting about 2.8%. So we will expect downtown mall rents to recover. But that's it. Back to Lend-Lease REIT. We like the REIT's fundamentals because, as I mentioned earlier, organically, you have growth coming in from the assets. And second, for a more important reason, is because of it has a very strong sponsor from Lend-Lease. And in Singapore, Lend-Lease has a large project, which is called the Paya Lebar Quarters, or PLQ for short, where you have a retail mall that's already operating and office assets there that are backed up very long leases. These will form part of the acquisition pipeline for the REIT, and we will expect them to execute on the acquisitions of these on a piecemeal basis, I would say perhaps in the next 18 to 24 months.
Thanks for that, Su Tye. And keeping on the theme of the transition away from work from home and back into the office, Teddy has a question for you, which is, what's your view of office REITs when it's likely that companies may be renting less space rather than keeping their current space? Because there will be companies that will be offering the option of either hybrid working or full-on work from home to their staff from here on. So what are your thoughts on that, Su Tye?
Yes, so that's a great question. So it is a big trend. It's a big trend theoretically, but in terms of the actual physical anecdotal evidence that we are seeing here, it hasn't really taken off in a big way. So the office and we've mentioned this quite a couple of times in the last year itself to some of our investors, that the office remains extremely relevant, but the form that it's going to take in terms of the physical office has changed somewhat. When we went into lockdown, there was some appreciation that we will see downsizing happen in a big way. Some of the banks in Singapore have given up their space. DBS, for instance, has given up, I think, 30 to 40% of the space that they previously leased at MBFC. Citigroup, similarly, at Asia Square Tower, they have given up also, I think, 30 to 40% of the space that they have there, over 10 floors. And these are permanent return of space.
Wow.
But we also saw very strong backfilling efforts. And that has been underpinned by the tech demand has come into Singapore in a big way. Apart from new demand coming in from tech tenancies, coming in also from private wealth, from high net worth, and from consultancy firms, we also saw relocation activity as some of these firms took flight to quality. So essentially, when you have vacancies in the core CBD area, these firms that were not previously leasing up this space took the opportunity of lower rents back in 2022, and we saw that rents in back in 2020, and we saw that rents and Grade A office rents came down in 2020 by about 10%. They took the opportunity to lease up the space. So if we look at it from a net basis, then new demand, relocation demand, essentially overshadowed some of the space that were returned as due to the work from home. We think that the work from home trend is probably not going to be so meaningful going forward, and therefore I think on a net basis, actually demand should definitely offset any of this less impact from work from home. Apart from that, I think I want to mention that our thesis for office not only comes in from stronger demand also coming from a cyclical recovery that we are seeing globally. So generally, office sector tends to do extremely well when you have a cyclical recovery. And right now, in spite of all the macro uncertainties, whether it's due to Russia, Ukraine, or whether it's due to the fact that that China has not fully come out of a period of lockdown, whether we are seeing any of that, Singapore's GDP is going to grow, and therefore office demand is going to grow. Apart from demand growth, we need to focus also on supply. And for the first time, we are seeing almost no supply coming into the Singapore, in terms of new supply coming into the Singapore system. And where you have demand growth combining with no supply, rents have only one way to go up. And I think across the board, even if we look at that, the market is not pricing in a very aggressive rental recovery. So this year, we are going for about 6.5% improvements in office rents. The market is going for somewhere between 5 to 7%. I think there's probably upside to rents this year. Next year, the market is pricing in around 5 to 6%. I think there's probably upside there as well. And that's the reason why we are extremely positive on the office subsector of the retail REIT space.
Thanks for that, Su Tye. And it's the next question. So heads up for you, next question I'm going to be asking is likely to be related to tech and data centers in Singapore. But just a quick comment that it appears that Singapore looks more and more like one of those safe havens that companies and individuals will look to when you have geopolitical risks increasing across the world. You know, we've seen in addition to the sensitivities over in the Ukraine and Russia region, we have had a missile attack in Saudi Arabia, miles away from where an F1 race is happening. So these things are very real. And I think Singapore does have that reputation worldwide as somewhere, as a bit of a unicorn. We are sort of shielded from all these risks, right?
That's absolutely right. Singapore is a small country. we try in our different policies to show that we are trying to punch our weight, whether it's economically, but we try to stay away from any of these political views unless it goes something against our principle. And I think that's where it says. I'd rather not have any more comments about politics, as you can imagine. Yes, but I think
back to talking about REITs then. Su Tye, Keppel DC REIT, Digicore, we've got these great tech center REITs. So data centers, for a time, especially in 2020, they were the hottest thing in the markets. Are they still a good investment now? What do you think?
So I think the REITs, data center REITs specifically, well, they did extremely well, and we saw the yields compress in terms of the assets. We saw, the yields compress in terms of the actual Singapore REITs trading as well. Overall, as a sector itself, this remains a very, it's still a niche sector within the industrial REIT space. Overall, data centers make up less than 10% of total industrial supply in Singapore, and we also have a moratorium in Singapore that was just in terms of having new data center supply that was just recently lifted. Overall, the demand outlook is still solid, and this is coming in, and we saw this being demonstrated through the pandemic. Higher data usage, higher digitalization. Stronger demand from essentially e-commerce supporting all of that data usage across the sector itself. And therefore, I think there is no question in terms of the demand outlook. What we are seeing is still acquisitions being targeted towards data centers, and that's why we've seen the yields compress. We still expect cap rates for data centers to compress because of capital still eyeing investments into data centers. So we don't cover Keppel DC REIT, so I don't have a formal recommendation for that. And we don't cover the new REIT listing, which is Digital Core REIT. Of course, Digital Core REIT has done extremely well since the IPO in December last year. And of course, investors who own the REITs must definitely be waiting for the first acquisition that they're going to do, which will be coming pretty soon, which would, I think, very likely be accretive given the fact that they have a very strong balance sheet to execute on the acquisition. But what we do cover in Singapore that has significant data center exposure is going to Mapletree Industrial Trust. Mapletree Industrial Trust has also done well, because this is a REIT that you must understand came from a very, very boring asset class of old factory buildings, light industrial buildings, and they have done extremely well to reconstitute the portfolio. First, organically, in which they have taken old assets in Singapore and refreshed them through build to suit. So in Singapore, and just to share, and old industrial buildings tend to command rents of an average maybe $1.50 per square foot per month. But it's very, very low. So industrial properties amongst the entire value chain of properties in Singapore are in trade at the lowest. And of course, there's still also a variation between whether you are the first ground floor space or whether you are the highest floor space, especially when it comes to warehouse space, because the ground floor space commands significant premium to floor that's on a higher level. So back to Mint. This is a REIT that has transformed itself from build to suit. So essentially taking some of the old assets, redeveloping them, releasing them into two tenants that require higher spec space. So a new build to suit space can command $3.50 per square foot per month, essentially more than double what they used to command on the same property itself. They have executed very well in Singapore in terms of growing rental income from build-to-suit projects. They also have delivered in terms of growing the data center exposure in Singapore, but they only meaningfully got into data centers through an acquisition of portfolios from the sponsor back in 2018. So from previously having insignificant contributions from data centers to the portfolio, today data centers make up 54% of the total AUM. That's a big jump from 2018 levels. And therefore, this is not the same REIT that you will recognize 4 years ago.
Wow.
The valuations of MIN also have re-rated on the back of the shift in terms of the portfolio, but it has pulled back last year. And the reason for that is because of the way the equity markets were trading. Investors felt that this would be a hurdle for the REIT to raise capital and therefore to support growth in terms of acquisitions. I think this is a valid concern, but I think the REIT also has its balance sheet to deploy, and we will probably have to wait and see which properties they are going to acquire next. They are going to acquire, in my view, another data center portfolio in the US. They are also going to acquire, and they have been talking about this for some time. They are focusing on acquiring a data center portfolio in Europe. These growth strategies remain very much in place. If you want to look at data centers, I think if you look just on the valuation side, MIN is trading easily at 100 basis points, less demanding valuations in terms of dividend yields than your pure play Capital DC and your digital core REIT.
Sounds to me also like there's a bit of correlation with the tech stocks also, right? If it's it sounds like if they fell together with it, a little bit of correlation there. Next question for you. Su Tye, also a quick comment from me. I just realized that this week, Malaysia, one of the ministers announcing that they're looking into making Bitcoin and cryptocurrencies legal tender in Malaysia. So that may have some impact on data centers in the region. I don't know about the industry, the availability over in Malaysia. Obviously here in Singapore, I've got friends who are telling me that they are buying mining rigs and putting them in buildings in Tuas. So, there's something there, probably. Moving on to healthcare. Wow. Helen is asking, so Parkway REIT, how? Healthcare?
So we don't cover healthcare. Parkway REIT is really just a pure play healthcare REIT. If you look at the share price, it's done extremely well.
Yeah,
I think it's trading. Yes, it's trading on 2% dividend yield. I can't comment because we don't cover it, but of course, if you are a shareholder, you will be a very, very happy shareholder. I think there are other niche segments of the REIT space that you can play into. I thought it would be worthwhile to mention, apart from the cyclical REITs that we go into, which is like the office REITs, and then of course, right now you have retail REITs. They are also obviously going to benefit from the recovery and the reopening trades. We also have hospitality, which I didn't talk too much about because we generally are still a little bit, we're holding back on hospitality because I think we have very little visibility. As we know, our Singapore government has supported occupancy levels for the hotels and the hospitality REITs in Singapore for the better part of the last 2 years.
Yeah, I remember speaking to the CapitaLand CEO, and he was saying, well, actually, we've actually done better in 2020 and 2021 for our hotels than in previous years because the government was renting all our stuff. And my mind was blown. I was like, what? You did better in the pandemic? He said, yeah, the government actually, because they booked up all our space.
Exactly. So we are extremely grateful. I think the sector-wise has been extremely grateful. Not only has there been support on occupancies, there has been support on labor. And that's the reason why many of our workforce in the hospitality sector has, there has been very much less retrenchments than what we will expect when we have close to zero demand. So I thought I want to mention this because if we will talk about healthcare as a 2% dividend yield, why don't we look at a very niche segment of hospitality, which is in rental housing and student accommodation.
And so the ART to CDLHT, right?
That's right. So the REITs have pivoted into this niche segment because they are also aware that RevPAR recovery is still not so visible, because this year when we have our government taking back and easing some of that support, because we don't need hotels to be occupied anymore, to support isolation demand. The REITs suddenly find they need to target and work harder to gain, to compete for leisure demand. And suddenly you have many hotels, but much less demand. So we will expect occupancies to be affected, and we will expect RevPARs to be affected. And therefore, this is going to be a situation this year and next year. And the REITs have moved outside of Singapore to acquire rental housing, PBSA, purpose-built student accommodation. I think Ascott Residence Trust has done this in a very meaningful way. They exited some properties before the pandemic. So they sold down assets at extremely attractive exit yields. Therefore, they had substantial capital to deploy, and they have deployed these capital very quickly. So last year, they increased their investment mandate into rental housing and PBSA. They set a target of 15 to 20% of AUM. By the end of last year, it was 16%. So they set another target to 25 to 30% of AUM. The momentum is extremely strong. And therefore, if you think this is a REIT that did execute well on growing into this very niche segment, and the valuation still does not reflect this sort of shift in terms of strategy, I think it's worthwhile a look.
Okay, Su Tye, we've got 5 minutes. I've got 2 more questions for you.
Okay.
First one is the big one. So Jay Powell, the US Fed Reserve Chairman, is going to increase interest rates. It could be 250 basis points or more. And that's a lot over the next year.
Yes.
So how is that going to affect REITs? Because REITs are very interest rate sensitive, right?
Yes, that's right. So we think our house view still is 190 this year, and then I think we expect this to peak somewhere 225. So it's a little bit lower, and therefore I think there could be upside risk to the US Treasury yields in the near term. I think it's really also due to inflation pressures, and so as you mentioned earlier, a very hawkish Fed. But the medium-term growth outlook could also be affected, limiting, I think, the rise in longer tenor yields. We expect a flat yield curve. We expect a flatter yield curve by the end of this year, unless the Fed goes aggressive on balance sheet reduction, which could steepen the yield curve. But as a whole, we expect the yield curve to flatten. And that's the reason, and really that's part of our basis of being positive on the REITs, because the REITs have put back, because yield curve steepened last year. We're expecting less of this to happen. And therefore, and I wanted to provide also in my slides just now, the sensitivities should the Fed hike higher than what we are pricing into our forecast on DPUs, as well as our forecast on valuations.
And so, final question for you. This is quite a big one also, because sometimes when retail investors go into REITs, they just look for the yields. They just look at which ones are the highest yield and then filter. 8%, 9%, let's go. Suddenly they're buying retail space in Indonesia. It's a bit of a trap sometimes. So the question here is, why do you think the US REITs such as Manulife and Prime are commanding such high yields, about 9%, similar to like Cromwell and Elite, the Euro REITs as well? Su Tye, what are your thoughts on that? The really high yielding REITs.
Yes, so that's a great question. So thank you for the question. I think we cover Manulife US REIT, we cover Prime US REIT, we don't cover Cromwell European REIT. These REITs, generally overseas REITs, trade at a wider valuation gap in terms of dividend yields to Singapore focused REITs. And that's reason for that is because these REITs generally, there is a lack of understanding of these particular markets, which justifies the discount in terms of valuations to the pure play ones. I think as the market understands these, as investors understand these overseas markets better, it should help to support and help in terms of the re-rating of these REITs. Importantly, one needs to understand the fundamentals of these particular asset classes that we are investing in. For an investor, not only an institutional investor, but a retail investor as well, you must believe that the demand growth for these particular office assets that, for instance, Manulife US REIT holds or Prime US REIT holds, to believe that these assets are going to be backed by growth in rental income, and therefore also support the growth in terms of distributions for you. So a little bit of work would be helpful to support your understanding and therefore justification of whether these REITs should be trading at these yields or the discount gap should narrow.
Thanks for that, Su Tye. So folks, do your own research for this. This one you must research. Su Tye, we've got a minute left, so I'm going to leave you that time to do a quick wrap up.
So thank you everyone for joining us today, this morning. I apologize just now. I think there was slight problem with my slides that I shared. I apologize for that. But hopefully, I think the thesis that we went through, our preference is on hospitality, industrial REITs, followed by retail REITs, and then hospitality. Our top buys within the sector, Ascenders REIT, CapitaLand Integrated Commercial Trust, Mapletree Industrial Trust, and then Suntec REIT. We have another 10 buys within the space. I didn't have a chance to talk through them, but hopefully, if you have further questions, of course, you can reach out to Maybank Securities here in Singapore, and then we'll get back to you. Take care, everybody. Have a good Sunday. Yeah.
Thank you. Much appreciated, folks. That was Mr. Chua Su Tye, the head of REITs research at Maybank Investment Banking Group. So yes, as he mentioned, do get in touch with Maybank Securities if you'd like to find out more about his research. They'll be very happy indeed to help you out with that.